In this video, we're going to talk about the multiple day high or low method of placing your stop. Stay tuned. Hey traders, a very warm welcome to you. Okay, stop losses, so important to manage the risk, cap the risk, keep those boundaries in place and let us fight another day. Now, we know that it's crucial with stop losses that we don't want them too wide, that we're risking unnecessarily, nor we don't want too narrow where we're getting stopped out all the time. And that's the key with stops. And I think that focusing on stops is something that's very important to kind of really stretch you as a trader. So one of the ways of placing a stops, and this is really for swing traders, but we'll talk in a little second about how day traders can potentially use it, is using the multi-day high or low method. So in other words, if you're going long, you're going to basically say, okay, I'm going long and my stop is going to be under a 2-day low. So in other words, the lowest point that we had 2 days ago. So let's have a look now. I've got the DAX up here and we'll look at some other charts as well in a second. Let's pick anything in it, and again, purely for argument's sake, let's say that we had, let me draw a line here, let's go with the traditional breakout. We're all very familiar with that strategy, and let's say we bought a breakout here, and let's say we bought the breakout here and our stop was under a 2-day low. So in other words, if the price goes back under the lowest point over 2 days, we're out. Let's look at the pros and cons of that. So the advantage is, if you're involved in a mega trend, you're going to ride that wave for as long as possible. The disadvantage is it can actually end up giving quite a lot back. So let's just say we went long here. We went long at this point here, breakout strategy, or whatever it may be. As we go from day to day, the stop is going to get ratcheted up. Obviously the low now, if we go long here, the low on a 2-day period is going to be here. So that's quite a bit of risk. You know, it's a 400-point risk. So bearing in mind, it's something that we've got to be careful of. We might want to do it initially. If we're buying a breakout, would we want to hold it all the way back below there? Again, this is a decision we have to make as traders. For me, that's a little bit wide, but for others who are looking for, you know, maybe the next quarter for the market to move on in their favor, it might be a very, very sensible thing to do. Anyway, let's look at how it works. So 2-day low, then as we go and we close here, the stop comes up to here, and so on. And at this point here, we start to get a little bit close. If I zoom in, we start to get a little bit close. You know, we've got a 1-day low, and so this is a 2-day low, and this day here, this candle right here, nearly takes out that 2-day low, but doesn't, so we're still in the trade. We're still in the trade, still in the trade, still in the trade, and actually it looks to me like we end up taking out the 2-day low, is this candle here, and gets taken out on this day here. So that's the low 2 days ago, that gets taken out. And obviously, you know, nothing is going to be perfect, but that keeps us on a big chunk of the move. But unfortunately, as the volatility compressed, that 2-day low's gone right up. But the good thing is we haven't given a lot back. And if you look at a scenario like, can I find one here? If you can imagine that this candle reversed heavily here the next day, you're giving back, and let's say you went long here and you had a 2-day low, went high, that then became your stop. You end up giving back all those gains from 2 days if it reverses on the 3rd day. And if you get that push up, that immediately reverses 3rd day, you've given it all back. So that is a disadvantage with it. You've got to be very careful that you're not giving back too much. However, you know, it keeps you on board, and obviously you don't have to use 2-day low. You can use, you know, multiple days, whatever it may be. Let's have a look at something like Euro US dollar. Again, daily chart we've got up here. You get the idea. You can have maybe, let's say, a 5-day low or a 10-day low, or whatever the case may be. Obviously, the wider you've got it, or the higher number you've got it, the more likely you are to get on board longer trends and to be able to sit through consolidation and congestion. The tighter you've got it, you're really looking for that momentum trade that's going to get you out pretty quickly. But of course, you do have that added risk. If a really good day and the next day reverses, you know, you've given all back all those gains. So again, that's the decision of a trader. There's no right or wrong. If you have a look at a kind of day trading perspective, Euro US dollar 15-minute, or let's go for a 60-minute, probably a little bit better on the currencies. You can kind of use an hourly thing as well and say, okay, a 2-hour low, a 4-hour low, a 1-hour low, a 1-hour high, whatever it may be. So adjusting your stop to that low from the previous hour, from the previous hour, from the previous hour. So again, you're ratcheting it down as you're going short with it, or as you're going long, whatever it may be, allowing the market to move in your direction and kind of keeping it with you. But you have got the potential, of course, that if you get a really accelerated hour that reverses, you end up giving it back. Again, pros and cons with all these kind of risk management strategies, guys, but something to consider, and maybe something to use in conjunction with another risk management strategy. So maybe something to use as a trading stop once you're already in, perhaps. If you see it, chugging quite nicely. There are instances where we've seen, I can't think off the top of my head a market, but literally just plodding along, and never looking back, never even breaking below lows, and that keeps you in those nice ploddy, steady trends. Not so good for volatile environments, but good for those plodding, steady trends where you just want to have really systematic, really kind of ironclad way of getting out of your trade. So anyway, that's the multiple day high or low method of stop, guys. Comments below, let me know your thoughts on that. Do you use that, or do you use something different? Be interested to hear. Need not the laptop over. Interested to hear your thoughts on that, guys. Take care. Bye bye. See you in the next one.